September meeting of the Federal Reserve. There is something to discuss here. This meeting is very long awaited. Finally, this meeting is taking place this Wednesday, and we can see that the current level of the federal funds rate is in range between 0.25 and 0.50, and the futures market sees the possibility of the Federal Reserve's rate hike at this meeting as equal to 15%. The possibility of rate hike in December is currently estimated by about 50%. So we can see that the market isn't ready to Federal Reserve's rate hikes. It doesn't really believe that this event will take place, despite the fact that there are US economic data are rather good, that we saw improvement in inflation figures on Friday. Still, the market players don't believe that this is the case, that we'll really see a rate hike. How to prepare to such event as the Federal Reserve's meeting? We'll see not only the decision on the rate, on the federal funds rate, but also the FOMC members will release their economic projections. We'll see the so-called Fed dots. It means that the Federal Reserve's members will share their own forecasts for the federal funds rate, and we'll see that they expect to raise interest rate this year or they don't. Of course, if we remember the last rate hike, which took place in December 2015, back then the projections of the Fed staff showed that there will be 4 rate hikes in 2016. For now, we saw none of these rate hikes. Maybe there will be something in September or in December, but of course 4 hikes is a very unlikely scenario. It's practically impossible scenario at this point. So of course the forecasts of the Fed members don't necessarily reflect future. The Fed can and probably will act not like they are forecasting, but still it is a rather important factor for the market's expectations. And we see that for majority of time, it doesn't really matter what will actually happen at the market, but more important is how the market evaluates different possibilities and what the market expects. These market expectations are the ruling factor for Forex market. So even if we have this forecast which says that by the end of 2016 the interest rate will be in range from 0.50% to 0.75%, which means 1 rate hike, then it will be a positive factor for the US dollar. You will see American currency appreciate because, as I have already said, the market is pricing a very low possibility of rate hike this year in the US, and if we have such forecast for a rate hike, the market will have to price in higher possibility of the rate hike, so it will be bullish for the US dollar. So watch the release of the FOMC economic projections. It will give you a pretty good clue about the Fed's attitude towards the rate hike. And also there will be a press conference of Janet Yellen, the Fed's chair, and she will be answering different questions about the US economy, about the Fed's policy. Usually the meetings of the Federal Reserve, which are accompanied by press conferences, are considered to be most important because It is believed that the Fed makes important decisions only if there is a press conference. So this meeting will be such meeting, it will be important, and market thinks that something may be said which will determine the future picture. And you can see in the table I have outlined some arguments in favor of the rate hike in September and against a rate hike in September. On the one hand, we can ask ourselves why to prepare for a rate hike, even potential rate hike, if the possibility of such event is so low, only 15% or even maybe less by some indicators. But we can see that traders are getting more and more nervous as the meeting approached. And we can see that there are many articles which say that interest rates should be higher and the Federal Reserve should surprise the market and increase rate in September. It is said that the market is pricing in very low possibility of the Fed's hike. It's true, and of course it would be more convenient for the Fed if the market was ready to rate hike. It priced in 100% chance that the central bank will raise rates. This way, the actual rate hike wouldn't be a big shocking event for financial markets. And now only 15%. But analysts say that always something happens which prevents the Federal Reserve from raising rates. This year we had some problems in China, the economic slowdown, Brexit, and other factors which constituted the external risks for American economy and were one of the reasons why the Fed put off the rate hike. Analysts say that probably the Fed needs just to forget about the market, stop being a follower of what the market thinks, and just deliver a rate hike just to be done with it. Let's get on with what already said some analysts. Uncertainty is not a good factor for the market, and although accommodative monetary policy is designed to help the economy, we now see that low interest rates are everywhere. We see that there is a 30-year bull market in government bonds. And we see that the situation may have gone too far, and maybe the Fed will make such a decision. In any case, there is a kind of big difference between what the market thinks and what the Federal Reserve might think. Actually, the actual opinions within the Federal Reserve are unknown to the market. Markets don't have good insight in what the Fed thinks, so this is why this event is so risky. So what are pro and contras for a rate hike in September? On the one hand, American labor market is in good shape. We see that the average growth of non-farm payrolls is high, the unemployment rate is close to the target level, and all is fine there. Financial market volatility is also rather low. The movements, the sharp moves in S&P 500 index were seen only recently, but in general, the volatility has been low in the past months. In addition, banks would lend more if they saw that the Federal Reserve's plans to raise interest rates and if it makes a small rate hike. And also a small increase probably won't hurt American economy much. It will help America to decrease policy accommodation a bit, but will be in line with how the economy is moving with American economic indicators. On the other hand, we see that although inflation has risen in the United States, it's still below the Fed's target level and probably will justify a rate hike only in December. Then the growth picture is mixed. The economic growth has slowed down in the second quarter of this year. There are indicators which don't show a very good dynamics. So we can't say that American economy is all well. Business investment is still lagging behind the growth in consumer sector, and this is an important problem. Then, as I have already said, market's pricing of a rate hike is too low, and this may prevent the Federal Reserve from raising rates this time. And the problem is that the Federal Open Market Committee, the FOMC, is too divided to act. Different policymakers of the Federal Reserve made different comments. Some of them were very hawkish. They said that there is risk that inflation will rise pretty quickly and that interest rates should be raised 1 or even 2 times this year. However, some of the policymakers said that inflation is too low and probably the Fed has to lift up inflation target and that further stimulus is needed. There is no need to hurry. So no unified opinion exists in the FOMC, and this decreases the possibility of a rate hike decision. And the last but not the least, we saw that after the Federal Reserve increased interest rate in December last year, there were serious disruptions in global financial markets. There were problems with China, and all in all, the markets of the emerging countries are very vulnerable to US rate hikes. We saw that hot money came to these emerging economies and will quickly get back to the United States once the market will see that the interest rates in America are getting higher. This will leave the emerging market economies without money in very poor state and create a very negative picture of global growth. And this is something the Federal Reserve won't like to see in future. So this is an argument against the rate hike. Taking all this into account, my base scenario is that the Federal Reserve will leave rate unchanged in September at 0.25–0.50 range, but will accompany this decision with projections of higher interest rate in December and some hawkish comments about the US economy and about the interest rates. I think that the Federal Reserve would like to keep its keep the image of December meeting live. It would like to the market to believe that the interest rate hike in December will happen and to increase the market's pricing of December rate hike. So it will deliver some bullish comments for the US dollar. And these bullish comments will may be enough to support the greenback versus other currencies and even to generate the growth of American currency. as the probability of hike is estimated only by 15% in September, then if there is no rate hike, the market players won't be very disappointed with the lack of a rate hike, and the negative impact on the US currency will be limited. So I believe that this September FOMC meeting offers some positive opportunities for the US dollar bulls, and that the US dollar may gain versus other forex measures. There may be different risk approaches for trading the US currency. For conservative traders, it would be better to wait until the Fed's meeting is over and to see what the Fed has to offer for the market, and then to rethink trading strategy to maybe create a more long-term strategy which reflects the and opinions which the Federal Reserve is going to reveal. For some riskier traders which are ready to take this high event risk, then it is possible to trade forex pairs. So we will see in a few minutes on the technical charts which are the opportunities for that. So I think that the picture about the Federal Reserve should be more or less clear right now.